Hey, my name's Robbie Crosier. I'm an M&A attorney and an adjunct professor of law at Texas A&M University Law School. And today I'm going to break down asset purchases versus equity purchases and pros and cons of either of those styles for buyers and sellers. So at a high level, I will say that most deals within what we call Main Street in the lower middle market, meaning deals, from $1 up to about $2 million. I would consider those primarily Main Street deals. These terms vary to some degree, but most of those you'll hear referred to as Main Street or maybe the low end of the low middle market. The vast majority of those deals are structured as asset purchases. It's just the way things are done. Asset purchases are typically a little bit simpler in nature. There's less due diligence to be done on the legal side, at least in these deals. So they're typically quicker, a little bit cheaper. The process is generally a little bit smoother most of the time. And so when you're dealing with lower value, in terms of purchase price, lower value transactions, most of these will be structured as asset purchases. So whether you're a buyer or a seller, don't be surprised by that. Let's talk a little bit about asset purchases and kind of what they accomplish for buyers and sellers. So from the buyer's perspective, regardless of kind of what segment of the market you're working in, you are almost always going to prefer an asset purchase. Now, without getting too ahead of myself, when you're working more complex deals, typically more expensive deals as well, there are creative tax structures such as F reorgs or F reorganizations that can kind of capitalize on the benefits of stock purchases or equity purchases and also asset purchases, where the buyer and the seller can both kind of have their cake. But generally speaking, without getting into that now, buyers are primarily going to want to see asset purchases as the primary purchase structure. And that's for two reasons primarily. One is tax benefits, and the other is liability avoidance. So quickly speaking from the tax perspective, because I'm not a CPA, at a high level, when a buyer enters into an acquisition in the form of an asset purchase, they are able to take advantage of depreciation and depreciate certain assets of the seller, depending on what kind of business is being purchased, and capture some tax savings because of that depreciation. That's kind of in a nutshell why that's useful. How much that's actually going to move the needle for you, will obviously depend on the total purchase price of the transaction. So I'm not within the Main Street and low middle market section or segments. I don't necessarily know if that's a hill that you should die on as the buyer, but that is something to keep in mind, something for you to talk about with your CPA. Additionally, and the thing that I would consider more important, unsurprisingly from my perspective as an attorney, are the liability implications, or more specifically, the liability avoidance implications associated with an asset purchase. So in an asset purchase, I think this is a common misconception that certain buyers have. They think, oh, if I'm going to enter into a deal in the form of an asset purchase as opposed to an equity purchase or a stock purchase, I'm not really getting everything. And I think that's because when folks hear asset, they assume, they think about tangible goods, they think about equipment and inventory, but they don't think about things like the trade name, the trademark, stuff that makes up the essence of the business. But the reality is these asset purchases, the vast majority of the time, are capturing everything, like the essence of the business as a whole. They're really not leaving anything out other than ownership of the seller's legal entity. So the way this works in practice is the seller's entity, let's just call it an LLC for this example. Seller LLC owns title to everything associated with the seller's business. So if it's a plumbing company, they own the trademark, Plumbers R Us, they own the trucks, they own the plumbing equipment, they own the customer contracts, everything. In an asset purchase, that LLC is going to sell all of those things to the buyer. The buyer is going to take ownership of all of it. So really nothing is left out. Nothing substantive is left out. What the seller leaves out that the buyer wants to be left out is any kind of underlying liability associated with the way the seller has been running that business up to this point. Because taking a step back, you as a buyer assuming that you purchase this business, or you're considering purchasing this business that you found on Biz Buy Sell, for example. Maybe you found it online. Maybe you found it on Facebook Marketplace, or you reached out to a local business broker and you've had a conversation with them. In a best case scenario where you have, all the information available to you that would typically be available in an arm's length transaction like this, the best that you likely have is like a SIM from a business broker, a confidential information memorandum, which is basically just a pitch deck, going over high level financials of the business and things of that nature. Nothing else. So you as the buyer, you don't have any idea what's been going on in this business up until now. You don't know how the seller's been running it. You might know from a financial perspective, but you don't know what kind of misconduct has been going on behind the scenes between the seller and their employees. You don't know how the seller treats their customers. You don't know if how often deals are papered up or just made on a handshake. You don't know if the seller pays his taxes. You'll get some of those things, in throughout the course of this acquisition once you're in due diligence, but a lot of this stuff you're never really going to know and wouldn't discover until after the fact. And so the way that you protect yourself, in addition to having your attorney do litigation searches and lien searches on the assets of the business to make sure they're not encumbered, in addition to that, you want to structure this thing as an asset purchase. So the vast majority of those liabilities I just described are not going to come with the business. If an employee from several years ago decides to sue the previous owner for something that happened back then, you don't necessarily want to be the one. You don't want to be the new owner of that seller's LLC, because now they're effectively going to be suing you, not in your individual capacity, but suing the company that you now own. You would much prefer to just take the guts of the company and leave everything else there. Similarly, if there's a customer dispute that, arises much later, years after, maybe a couple years after acquisition, something like that, you don't want to be on the hook as the same business entity that had been operating with that customer. You want to start fresh with your own entity, your own clean slate from a liability perspective. Now, there are still certain opportunities for things that the seller did to tie back to you, which is why it's important to carefully draft the purchase agreement to give you the opportunity as the buyer to hold the seller accountable for things. If a customer or some other third party holds your feet to the flames for something that the seller did that you had nothing to do with, you want to be able to force them to make it right through something called indemnification, among other ways. So it's still important that you have a well-drafted contract, but starting with an asset purchase as the base really sets you up for success as a buyer. Now, there are certain situations in which an asset purchase is not going to be feasible. I would say primarily the most common one within this segment of the market is a situation in which there are certain contracts, customer contracts specifically, sometimes vendor contracts, typically customer contracts, that cannot be assigned to a new owner. And what that means is, if you come in and you buy this plumbing company, the LLC stays with the seller. They're just transferring all the stuff, including the contracts. Sometimes a customer contract might include a non-assignment clause that says this contract, if the company comes under new ownership or something like that, this contract does not flow with the sale of assets. It cannot be transferred to a new owner. It has to stay with the seller's existing LLC. And typically, unless you get that customer to amend that contract and approve the assignment, typically the only way to remedy that situation is to just say, okay, I as the buyer am just going to take over your LLC then in the form of an equity purchase, or more specifically with an LLC, a membership interest purchase. And so that can become kind of a necessary evil in those situations. And I don't want to paint, you as speaking to buyers, an equity purchase is certainly not the end of the world. It is more convenient in a lot of ways. If the seller's company has a lot of contractual obligations, they've got a ton of employees with employment contracts, they've got a ton of customer contracts, they've got a lease, they've got a bunch of vendor contracts. and things are not easily transitioned over. Sometimes they can be, but let's say in this situation they're not. It probably makes the most sense logistically to enter into this as an equity purchase. And if the deal isn't massive, you're not going to be losing out that much on tax savings anyways. So something to keep in mind there. Speaking a little bit to the flip side, what does an equity purchase look like from the seller's perspective? Generally speaking, they get a little bit of a tax break. So just like the buyer gets a tax break on an asset purchase, the seller gets a little bit of a tax break on an equity purchase. That is primarily captured through capital gains, where they can attribute the proceeds of the sale to capital gains as opposed to ordinary income. And there are some additional factors that can help increase their tax savings on top of that. But they're generally speaking, a seller's motivation to do an equity sale will primarily be taxes. A seller is generally not overly concerned with trying to pass liabilities onto you and things of that nature. That really does not benefit them, because they know that you would probably have them on the hook no matter what in a situation like that. You would both just be in trouble now. So it's primarily going to be tax savings that or again, just administrative ease if there are a ton of contracts that can't easily be transferred. And again, from a buyer's perspective, it's not the end of the world. If you enter into a deal like this as an equity purchase, it may be necessary. Now, there is a third somewhat common structure called an F-reorg or an F-reorganization, which is a tax strategy within business acquisitions where you can essentially characterize the purchase as an asset purchase for the buyer and a stock purchase for the seller. So both parties kind of get the best of both worlds here. The trade-off for that is the actual facilitation of this purchase structure is going to be more expensive from a professional service provider's perspective. So you're going to pay your attorney more, you're going to pay your CPA more to build the structure out, because it's going to involve creating new business entities, transferring ownership from your existing business entity as the seller. Speaking specifically from the seller's perspective, you're going to transfer ownership from the existing business to a new business that you create before the purchase even happens. You're going to do some tax filings. There are a number of steps involved in that. So you have to make sure that it makes sense for everyone due to the dollar amount of the deal you're talking about. You want to make sure you're actually saving money on this. But that can certainly be a worthwhile strategy. And that's something that we do see on a fairly regular basis, and something that we handle for deals that are, creeping up 3 million plus, I'll say, kind of in that range. So I hope that helps, kind of breaking down pros and cons of asset purchases and equity purchases for buyers and sellers. Neither one are a bad option for either party, but there are certain benefits. And with that, we will talk to you next time.